Morning, friends. Welcome to ASA's Union Budget Seminar 2021. I welcome my colleagues who are with me, Sandeep, Sunil, and Himanshu, and the entire team who has been responsible for making this happen behind the scene. I'll straight away go into the overview of the budget, which is the resting on the 6 pillars. I would like to call this as a 6 engines for growth, because this stems from exactly from the one day before released the economic survey, which has been tabled in Parliament by Subramaniam, the CEO, Chief Economic Advisor. And the 6 engines are health and well-being, physical and financial capital and infrastructure, inclusive development for aspirational India, human capital reinvigorating thereof, innovation and research and development, minimum governance and minimum government and maximum governance. And we have been hearing from the government that this is a budget which is the series of budget which is going to be presented earlier, right from the pandemic started. So this could be considered as one of the budgets, and there are many more things to follow. This was given by the CEO of India, the Prime Minister, and this has been echoed by the FM speech as well. So this has set the tone, and instead of calling this as a bold, beautiful, and brave budget so far presented, I would like to call this as a visionary statement of the country India. Because this has sowed a far-fetching the changes in the banking power, increased capital outlay on key sectors like roadways, railways, metro rail, port development, micro irrigation, and much needed gas connectivity. And the government thrust on privatization and push to the start have also been on the top agenda. Further, the asset monetization of the PSUs through the form of disinvestment, further capitalization of the PSU banks, and privatization of or disinvestment of couple of PSU banks. One of the insurance companies were also on the anvil. There is going to be and I recall the economic survey which talked about 10 different items like keep up spending, economy to go past pre-COVID levels in 2 years' time, barring the scar which we have due to the pandemic, Higher growth will keep the debt in check in spite of more borrowings. An eye on core inflation for policy making. Indian banking needs an asset quality review in support of farm laws, pointing to a problem of over-regulation. Then healthcare. Then exports to be given a fillip. Can't rely on jugaad, and it has to be a real R&D. So these are all the things which we have to, which has really gone. The economic survey has been reflected straight away into the budget. And I will touch upon few while my colleagues, both Sunil as well as Sandeep, are there for direct taxes and indirect taxes respectively. I will not go and delve deep into that, but I will just touch upon some of the items which has got the very important to be mentioned in my opening remark. The uncertainty in reopening of the provisions in the assessments have been eased through the current provisions of section 147 and 148. Let me not go into the sections. The number of years for reopening has also been reduced, hastening up disputes through different mechanisms for settlements, advance rulings, as well as for a small taxpayer have been introduced. Adjustments permitted in the computation of the book profit under section 115 GB, what we call as a MAT, both through the secondary adjustment as well as the advance pricing agreement, through a simple rectification proceedings. So far, there has been a need of the hour, and many professionals and corporate bodies have been calling for this, which has come into being. There is an anomaly in withholding provisions requirement on the dividend receipt by the business trust have been given exemption with retrospective effect from 1/4/2020. Enabling provisions introduced in the demerger definition in the Income Tax Act for the purpose of enabling PSU's divestment. Progressive measures introduced for various types of services of the units situated in the IFSC through tax exemptions. Real estate, affordable startups continue to have tax exemption for one more year till 31/3/2022. Of course, it comes with a pinch of salt as well. There are some practical difficulty which could be posed by bringing in certain provisions like in the TDS in the form of section 194Q and 206 AB, 206 CCA, though I consider these as anti-abuse provisions, but anyhow, these could pose a lot of practical difficulties. The legislatures seem to be over-skeptical by specifically excluding goodwill from intangible assets for the purpose of depreciation, which I consider even in the genuine cases it could pose it could be a retrograde. But these are all slightly a downside, a small downside on the direct tax proposals. On indirect tax, I have ITC available only if GSTR 1 is filed by supplier. This has come into the statute itself. Then detention, seizure of goods while in transit. Penal provisions are going to be harsher. Zero rated supplies to SEZ only in respect of goods and services used for authorized operations. These are all under the GST and customs. The high-speed rail has been brought under the list of projects import scheme, and all conditional exemptions to end in 2 years from the grant. Like GST electronic portal, customs is also going to bring in. So this is it's a digital digitalization is in full swing. And of course, in the direct taxes, more and more faceless schemes are getting deeper and deeper in various dispute redressal. And I have my colleague Himanshu, who is going to talk about the policy changes, the FDI changes, the corporate laws changes, and Securities Act or SEBI related changes, banking related changes, all these things he is going to cover. So over to you, Mr. Sunil, for taking into the direct taxes.
Thank you, Venkat. Thank you for the introductory remarks. I think well said when you sort of summarized how the budget has changed, or they've tried to change the landscape here. So friends, I'm going to talk about some of the provisions that have been brought, some of the proposals that have been brought on the direct tax side. Now, direct tax always has been a mixed bag. In the previous budgets that we have seen, there is always one difficulty which I have felt as a tax professional, is that it's always very difficult to read the mind of the government and of the administrator, what they're trying to do. But this budget, I think, is very different. The tone and the flow of the budget is very clear. And I think that's the biggest success of this budget. The government has taken, call it aggressive, non-aggressive positions, but they've at least taken a position. So I think the mindset is very clear that they are here to take decisions and make it easier and simpler for the businesses to proceed. So there is more certainty in whatever they do. So what they've done is, they've sort of moved around a bit, tried to take care of some archaic issues that were there, tried to take positions into some very, controversial issues, contentious issues. So what I'm going to do is I'm going to focus on just about 3 or 4 of them, which are, I believe, issues that are going to impact foreign businesses, issues that are going to impact, matters in practice. So this budget had about 45-50 odd proposals, and as I said, there are a lot to do with course correction. Give me the next slide, please. So this is how it sums up in terms of my overview of this budget. There have been no changes to the tax rates. The finance minister, and all the reviews that I heard, reaction that I heard, people were expecting a COVID cess. There is no COVID cess. So that's a very positive remark with which this budget has started. There is a thrust on technology. When this government came, there was a thrust on Digital India that has actually led to the tax authorities looking into the faceless technology to do assessments, to talk to the tax officer. There is a increased thrust on that, and I will tell you more about it later. The dispute resolution avenues have been completely overhauled, and this is something which actually came as a surprise, but it's a very, very welcome move, and I'm going to talk more about it. The scope of equalization levy, India's version of the digital service tax, it has been widened. How it looks like now, I'll be able to give you some tips there. There has been a major push to sort of promote the India's position in the financial market, and that has been a major push in this budget. But these are more technical proposals, so I'm not going to discuss more about them. But if you have any specific questions on the IFSC, very happy to address that. And then, as I said in the beginning, there is a thrust on compliances, on timely compliances. We are trying to sort of tighten the noose around the administration of the entire tax regime, which is again a very, very welcome move. Foreign businesses for long have been, coming back to the administrator and telling them that your timelines are very, very long, and there is always a constant threat of authorities coming back to us after 4, 5, 6 years. So that has been tightened, and therefore this is something very critical. Next slide, please. So I think one of the very critical takeaways from this budget is what the finance minister has done on the tax disputes and the litigation regime, and I think this is a big success of this government. To begin with, what they've done is they've said that the scrutiny assessment, and I remember I've seen times when the timeline to complete scrutiny assessment was more than 2.5, 3 years from the end of the assessment year. What they've done now is they've said the current timeline is about 12 months from the end of assessment year. And they want to reduce it from 12 months to 9 months. The reason behind this is that the government is now technologically very ahead. They obviously collect data on a real-time basis. They analyze a lot of big data. The sources from which they collect information is almost on a real time. And therefore, the government feels that they are appropriately positioned now to take decisions much faster. If there are issues that they want to flag, they can flag it in a lesser amount of time compared to what they used to take earlier. So I think this is a very, very welcome move. So what is going to happen now is starting assessment year 2021, and I'm referring to the financial year March 2020. The deadline to conclude assessment, which was March 2022, will now be December 2021. So that's a significant shift of 3 months. And similarly, all the other deadlines have again reduced by about 3 months. Another big change, and again a very welcome change, is something that we have seen on past matters. Besides the issue of retrospective taxation, this was one of the issues that was a grave cause of concern for the foreign investors. So what used to happen was that under the Indian assessment window, the tax administrators were allowed to go back 7 years from the end of financial year was evasion of tax. Now, what they're saying is, unless there is an issue of serious evasion, and serious evasion has been defined specifically, unless you find an issue of serious evasion of tax, any reassessment can only be done within 3 years. So a notice of reassessment that you get can only be done within 3 years from the end of assessment year, which effectively means end of 4 years from the end of the financial year. Now, more important is the other aspect, and they're saying that before issuing a notice for reassessment, the taxpayer will be given an opportunity of being heard. So you will obviously have a say before you are issued a notice, and I believe this is to mean that if they find that the issue does not have a merit, then they might as well take it back as well. And therefore, this is a very, very welcome move. Now, just one caveat. The caveat is, in case of serious evasion, cases where they are able to establish serious evasion, the department can go back up to 10 years. But they're saying they need evidence to go forward on this. Amongst the other changes, while revamping the entire tax dispute and litigation regime, they're saying that the good old settlement commission, they have done away with the settlement commission. And the cases that are pending before the settlement commission, they have set up an interim board. And this interim board is going to decide how these cases will be settled. Now, as you know, Settlement Commission had a lot of powers in terms of waiving interest and penalties for the taxpayers. How this is going to play in the future, there are other forums that they have set up, but will this equate with the Settlement Commission? I don't think so for now, but perhaps in the future it will. The Advanced Ruling Authority, it has been rechristened as the Board for Advanced Ruling. Now, as you know, there were administrative issues in running and maintaining the constitution of the Advanced Ruling Authority. So what they've done is they've realized that there is a lot of time lag in disposing cases at the advanced ruling authority, and therefore they have completely done away with advanced ruling authority, and they've set up a new board called Board for Advanced Ruling. And this board is going to be set up on an all India basis. Any matter that goes to the Board for Advanced Ruling is going to be allocated to a particular bench, and that bench is going to decide on this particular order. Now, the specific part of this development is that when you talk about Board for Advanced Ruling, an order of the Board for Advanced Ruling is not binding on either the taxpayer or the tax officer, which is a very, very welcome move. And therefore, you can, if you don't agree with the particular judgment, you can go and appeal before the High Court. And as always, and is the norm now, the Board for Advanced Ruling is also going to operate in a faceless manner. This word faceless, friends, you're going to hear over and over again. Any proceeding that you will see in the tax authority, in the tax administration now, is going to be operating in a faceless manner. Next slide, please. For small taxpayers, and when I say small taxpayers, they have come out with a new alternate dispute resolution scheme, which is going to be run through a dispute resolution committee. Now, this committee will be set up, which will have officers of the level of chief commissioner, and small taxpayers, which mean that taxpayer where the returned income is up to 50 lakhs, or the issue that is being discussed as a variation or as a proposal for adjustment is up to 10 lakh rupees. Now, I don't understand the reason why this has been set up only for small taxpayers. This could have, well served the purpose of the, high income taxpayers as well. But that's the law right now, and I believe that this is going to sort of take over from the Settlement Commission in the times to come. When you again talk about faceless, you see, friends, the tribunals also they're proposing now to go faceless. Tribunal being the second level of appeals, being a quasi-judicial authority working under the Ministry of Law and Justice, they're now proposing that this is also going to go faceless. How are the courts going to operate under the faceless regime? The rules are yet to come, but this decision is already there on table. Next slide, please. Now, these are the forums that you now see. So I just thought I'll just summarize it for you. You see revenue authorities, you see there are two forums, one new forum, DRC, which gives you, help you on the alternate resolution side. You see the two levels of appeal, the first level and the second appeal. And then you see two advanced resolution forums, the newly incorporated BAR, Board for Advanced Ruling, and the good old APA operating for the last 5-6 years. Next slide, please. Equalization levy, again, a very critical tax. Venkat mentioned about it in the beginning. Now, equalization levy, friends, is India's answer to the digital service tax. This was introduced in 2016. The first avatar was introduced in 2016. Last year in the budget, it came as a surprise entry, and it was imposed on e-commerce businesses. Now, there have been obviously a lot of issues on the way people have perceived this particular levy to operate. And the government has tried to sort of introduce some clarifications. They've taken a position, good, bad, whatever the position was, I think it's already been taken. So what they're saying is that if there is an income that is already subjected to royalty or fee for technical services, so for example, let's say a software license or any sort of technical service that is provided online, any assistance that is provided to the SSE, if that has already been categorized under the tax treaties, under the Indian Income Tax Act as royalty or FTS, and has been subjected to a tax, let's say on an average of about 10%, this income will not be subjected to equalization levy. And equalization levy is at 2%. The key difference, friends, is the 10% is creditable against your future tax liability in the home country. This 2% obviously finds no credit. But in any case, this position is clear now. The other big change, or the big clarification that they've come out with, is something that obviously is going to give rise to a lot of contentious issues. Is that they're saying, in terms of online business, when you define the term online, online includes any one or more of the following activities. So there's a transaction, and this transaction has any element where either the acceptance of offer for a sale, or placing or accepting or purchase orders, or even the consideration is paid online. This activity is covered within the purview of equalization levy. Again, if this activity is already subjected to royalty or FTS, we are not covering it into the equalization levy regime. But any element of your transaction, if it's online, even the payment of consideration part, uh, this is going to get covered into the equalization levy regime. Now, this obviously gives rise to a very pertinent question: is that when you talk about online elements in a transaction, will the offline or physical transaction, which has one of the elements, as let's say, for example, a physical transaction of selling goods through an agent in India, if this transaction is concluded by payment, which is done online, will that offline or physical transaction be subjected to equal or not? That's a very pertinent question. As it appears right now, all the transactions where you have an element of online are going to get covered. And then the last clarification that has come is they're saying that the equalization levy will apply on gross consideration. Now, whether the supplier owns the goods or not, so whether you are an intermediary, whether you are a commission agent, whether you are in any capacity, and whatever sort of incomes that you're earning, for example, if you're an e-commerce website, you could earn listing fee, you could earn commissions, you could earn your net margin by selling to a third party and buying from a vendor. Uh, I think it's very clear in the law now that the 2% levy is going to be on the gross consideration of the business that you do. So this is again a very, very clear thing on the table now, and I think there are going to be consequential issues, but for now this law is more or less settled the way it's going to be applicable. Next slide, please. So I think once the other issues that have been debated a lot after the introduction of the proposals is the provision related to the fact that there's going to be no depreciation on goodwill. Now, friends, just as a bit of a background, there is this, goodwill depreciation on goodwill was introduced in way back in 1998 in Section 32, where the sort of view was that goodwill is an intangible asset, because the definition very clearly says any other rights of similar or any other commercial rights of similar nature. So goodwill was always understood to be a commercial right of an intangible nature, and therefore the depreciation on goodwill was always allowed. Now, this issue obviously took a different turn when the Supreme Court decided in case of Smith Securities. The decision came, and the decision said that goodwill generated in the course of merger is eligible for depreciation. And obviously the argument was that goodwill, whether specifically paid for or not, anything arising as a difference between the sale consideration and the value of the business that you acquire, it happens in the course of the merger, and therefore it should be treated as goodwill, and there should be a depreciation allowed on an intangible like goodwill. Now, the budget, as per the budget proposal, I think the government have made up their mind in a very clear sense, and they're saying that effective 2021, goodwill is not going to be allowed for depreciation. So there is no depreciation on goodwill, even when you have specifically paid for this particular goodwill. The argument, obviously, behind this is from the government side is that goodwill does not lose value in the course of business, and therefore, ideally, it does not deserve to be depreciated, and there should be no allowance for that. Although, when you look at businesses and when you look at the impairment issues, goodwill generally is tested for the purpose of impairment, and it's generally difficult to understand. It's a conflicting view that for auditing, for accounting standard purposes, on one hand, goodwill is considered tested for impairment, and on the other hand, for tax purposes, there is no depreciation that is allowed on the goodwill. So that obviously is an issue that comes up, but that's the law today. So what are the two things one could think of? I think one immediate reaction that we get is that whoever has been claiming depreciation on goodwill for the year ending March 2021, obviously you'll have to go back to your tax computation and relook at your advance taxes that you have paid. If there is any consequent liability in terms of the interest that is there under Section 234B and C, that is something that you will have to consider. The other issue is that now when you conclude the transactions of M&As, you will obviously have to have a very clear look on the purchase price allocation. So what used to be comfortably parked or treated as in the purchase consideration, whatever used to be treated as goodwill comfortably, you will now have to allocate what is in the goodwill or what amounts to goodwill. For example, if goodwill is expressed in terms of the client relationships that you've taken over, the client contracts that you've taken over, any distribution lift, any specific IPR, a tangible, intangible that you've taken over, you will sort of have to identify the PPA with that particular asset. And that perhaps should help you. Obviously, the law will evolve and we will get to know more about it later, but that's the only two things that come to mind. Next slide, please. Now, these are smaller issues, but I'll just sort of take up just one of them, which could be critical, and this is relating to something that a situation that dividend had caused. So dividend, as you know, you don't know dividend until the time you receive it. So what they've said is a lot of people were facing a lot of interest burden because they could not pay advance tax correctly because the goodwill, the dividend was declared much later. So the law has very clearly come out and they've said that when you compute your advance tax calculations, you don't take dividend into consideration unless it is actually declared and you have received it actually. So that's a very, very welcome move. That's a very pragmatic step. And the other changes, there are not many changes, but not very significant for this forum. So I think these are the changes that I wanted to discuss about. Over to you, Sandeep.
After that excellent explanation about the direct tax proposals, I would take the participants through the indirect tax proposals. But before that, a few comments on the overall tone of the budget. I feel it's an extremely bold budget. It's an extremely ambitious budget to have. And considering that it is the first budget of this new decade of beginning 2021, I think the finance minister has set the ball rolling for the policies and procedures of the governments in the years to come. Largely, I would say this budget is being seen as a positive budget, and the prime drivers being growth, investments, and reforms. These would be the three main drivers, as we could see from the policies which are rolled out. As Sunil has very rightly mentioned, while we were expecting the COVID cess and we were waiting with bated breath for many more taxes and levies, considering the enormous burden on the government exchequer due to the unprecedented global pandemic. I think the FM has done a magnificent job in terms of setting us scot-free from any kind of a trepidation of increased levies and taxes, especially during these times. And I think that she has done in a very pragmatic way by not only being empathetic by not hurting the economy in terms of more charges, more taxes, and more levies. She's also taken a very bold stance of increasing the public expenditure as one of the key drivers for the future growth of India. The overall budgetary expenditure in this year's 2021 is estimated to be 35 lakh crores, 35 trillion rupees, if I may say it. And this move, I would say, is catapulting now India into the global forum as being an extrovert economy, which is not scared of having a fiscal deficit as large as estimated at 6.8% in the 21-22 fiscal year, 9.5 in the current year, estimated 21. I mean, we are now moving away from having an economy which was always shying away from a higher fiscal deficit, which were always trying to contain and control the fiscal deficit. And I think it's an extremely bold move for the finance minister to take in these times. Overall, I would say this is the beginning for a very new and confident, ambitious India overall. Coming on to the specific proposals of the indirect tax budget. Next slide, please. Ever since GST came in, the key aspects are essentially a few changes on the GST, because not very many changes can be done on the GST front due to the interference or the permissions of the council which are required under the constitution. So a few changes on the customs and excise and a few changes on GST are always expected. What we have seen in this year's budget is that certain key changes have been brought in on the goods and service tax front. along with a few reform measures on the customs and excise. Next slide, please. One of the most significant changes which they have done is scrapping of the GST audit under Section 35 of the Central GST Act. Now, this essentially means, of course, it's an easing of compliance burden on the taxpayers. Certainly, there won't be an element of an auditor's overseeing the reconciliation statement, the turnover, and the tax credits between the returns which have been filed with the tax authorities and the final audited accounts. But what it also means parallelly is that now the taxpayers will be responsible to self-certify the reconciliation statement on their own, and this lays a greater emphasis and a greater responsibility on the part of the taxpayers. So, you know, the noose is tightening across the board for any kind of defaults, fraudsters especially. So this makes it very critical for all the taxpayers to ensure that while filing the reconciliation statement, the errors and the omissions of the GST returns filed, they are taken care of. The complication here which I foresee is that while there is no date which has been announced yet for scrapping of this section, it is certainly going to be a prospective change. So while yesterday on Twitter, CBIC also clarified that the audit would be required for financial year 19-20, what remains to be seen is whether the scrapping would apply for financial year 2021 or whether it would apply for 21-22 onwards. So that I'm sure in the course of time they would be coming out with it. Litigation is something to be avoided in this case, and so the emphasis would now be on the internal teams of the taxpayers to ensure that the figures are reported correctly. We have been seeing a lot of tax evasion and revenue leakages on the fake ITC fronts. I mean, crores and thousands of crores of ITC frauds have been discovered. Many people have been put behind bars, including professionals as well. And the intent of the government is very, very clear to see that no relaxation will be given to any fraudulent activity as far as tax collections are concerned. And to this extent, the government has now put in a restriction that the tax credit will only be available to the taxpayer, to the purchasers, to the recipient of supply, in case the supplier has filed their GSTR1 correctly. The thing to be noted here is that the change in the wording of the law, the legal statute, talks about the return of outward supplies under Section 37, which as of now is GSTR1. But the problem which will be there in the case of larger industries having SME enterprises as their vendor base, where the SME vendors have the option of filing their quarterly returns. So what happens there? Does my tax credit get blocked till the time my vendor is filing it after 3 months, or am I still able to get the tax credit under the invoice furnishing facility, the IFF facility, which has been brought in the GSTN? I think these are the few things which the government needs to control, but the availment of ITC will become one of the key factors in terms of determining the interest levies, the penalties, and the prosecutions. The legal sanctity also has been given by virtue of this amendment to the various notices and the inquiries at random which were coming in for the mismatch between the ITC availed in GSTR 3B vis-a-vis the 2A statement. And there were quite a few litigations and judicial pronouncements on it. Now, by virtue of this statute being amended, I think all those controversies would be set to rest, and we can look forward to many more inquiries and notices in this regard. Also another catch here is that till now that leeway of 5%, which was hitherto before 10%, will that be relevant anymore or not? Under Rule 36(4), the taxpayers were entitled to claim of tax credit in respect of their unmatched invoices to the extent of 5% of the matched invoices. Now that certainly becomes redundant, and that entire rule has no meaning whatsoever going forward. Next slide, please. The scope of self-assessed tax, this has been increased to a very large extent, and probably I could call it the fine print, but this has a lot of devil in the detail if you go through the provision. So what they have said is inserting an explanation that self-assessed tax will also mean to include the tax payable in respect of outward supplies that's declared under the return filed under section 37, which is the GSTR1. Now just imagine the impact here, that in case I have declared my outward supply in GSTR1, but for some reason I have not been able to declare it and pay taxes in GSTR3B for the same month, I would now be, covered under the penal provisions by virtue of the disclosure of these supplies in my GSTR1s. And when I say penal provisions, it would mean the entire gamut of penal provisions, right from interest to penalties, and maybe in very serious, severe cases, there could be prosecutions also. Now, the key thing to note for all the taxpayers here is that the reconciliation between your 3B and 1 must be done within the same month itself. So there is no margin of error which the government is now giving the taxpayers, which I think is not in the correct spirit of ease of doing business, especially considering the way the GSTN systems are being handled. If they make a mistake, then they get away scot-free. Even now, the 2A is not being populated based on the GSTR ones which are being filed by the suppliers. So I think till the time technology settles down and is robust enough to have error-free reporting on the side of the government, on the side of GSTNs, I think these kind of severe provisions could be kept in abeyance. Next slide, please. They have done quite significant changes in terms of the zero-rated supplies for exports, as well as zero-rated supplies to SEZ operations, as Venkat has mentioned in his introductory remarks. Earlier, any supply to a SEZ unit or to an SEZ developer was considered as a zero-rated supply, and there was an option to either make the supply under payment of tax and claim a refund subsequently, or go in for making the supply without payment of any taxes. But now the amendment has been made in the relevant provisions saying that these supplies will be permitted to be zero-rated supplies only if they are in respect of authorized operations of the SEZ. Now, this will again trigger in my mind a lot of disputes and litigations in terms of what supplies are linked to authorized operations and what supplies could not be linked to authorized operations, especially considering, let's say, the consultancy fees or the audit fees. Can it be deemed that they are linked to authorized operations or not? Will the credit be denied there or not? Will it become a cost on those SEZ units or not? Those are things. The other aspect which they have changed here is that earlier there was no time limit in terms of realization for export of goods. Now they have brought in a time limit as prescribed under FEMA, and they have further said that in case refund has been taken on exported goods and the realization does not happen within the time frame provided under FEMA, then the refund is liable to be paid back to the government along with interest. Now, these two things together, coupled with the third thing which they have added, is that a zero-rated supply will now, by default, will have to be made without payment of tax. The discretion of the taxpayer to make supplies under payment of tax and then take a subsequent refund of ITC, because that was a easier process in terms of export of goods, that has been denied. And the government has said that only in respect of class of persons or class of goods or services which will be notified can zero-rated supplies be made with payment of tax. Next slide, please. Amendment has been made in the definition of supply. Now, this is essentially to cover the supplies between clubs and its members, and there was a Supreme Court ruling in the case of Calcutta Club. The government has gone back on its assurances of not doing anything retrospectively. They have again overturned the judgment of the Apex Court of India, and now they have brought in a provision to cover any kind of supplies between the clubs and its members. And so by virtue of doing this, they have done away with the concept of the principle of mutuality. This is to be noted with retrospective effect from 1st of July 2017. This could lead to potentially a lot of litigation of the past cases. Next slide, please. In terms of other key changes, I would say that they have come down very heavily in terms of controlling the frauds and fraudulent movement of goods. So the provisions in respect of seizure of conveyance, seizure of goods while in transit, detention of goods, they have been tightened tremendously. They have also brought in a condition of pre-deposit of 25% if you want to go in for an appeal against the penalty which is levied for detention or seizure of goods. They have also done away with the restrictions on the tax officer that an opportunity had to be given before levying any kind of before the detention or the seizure or levying interest or penalties. They are saying now opportunity can be given only if the penalty is to be levied and not for other things, which means the tax demand and the interest will become an automated process without the taxpayer having any say or without the taxpayer having any forum of representation why it should not be levied to present his case. I think these are some harsh provisions which they have done, and to my mind it is a classic case of like in school there were a couple of guys who were very naughty, and because of them the whole class used to get punished. I think the government, in trying to control these fraudsters and the fraudulent activities, the honest taxpayers will also suffer a lot of difficulties in terms of complying with these procedures. The other consequential change they have also made is retrospective from 1st of July. This is beneficial to the taxpayer, where they have now clarified that that interest would be levied only on the net cash liability. But the way it is worded, it brings to the front another ambiguous nature, that the provision which is now put on the statute talks about interest levy only in the case of delay in filing of a return. So there they are saying that the interest will be levied only on the net cash liability, whereas in case there is no delay but there is an omission of liability which is paid in the subsequent month, then what happens? Then would the interest be levied on the gross basis? Would my tax credit not be allowed as a set off against my gross tax? Those are the challenges which you need to see. Next slide, please. I just have one more slide and then I would like to hand it over to Himanshu. In terms of customs and central excise, there have been changes in the rates of duties. Some have gone up, some have gone down. But the critical element here to see is they have brought in an AIDC, Agriculture, Infrastructure and Development cess, on a couple of items. But the government has also clarified that there would be no consequential tax, the cost impact on the people, because the connected basic customs duty or the excise duty on petrol and diesel, they are also being reduced. In fact, the rates are supposed to be favorable in terms of the end customer. The end cost is supposed to come down with it. But this certainly would give more funds to the government to deal with it. They are also doing away with relooking at 400 odd exemptions under the customs notification. There is a sunset clause of 2 years which has come in. Common portal similar on the lines of GSTN is now being talked about for customs. So everything which we need to do on custom, whether it is obtaining registration, filing bill of entries, all those would be through the common portal. 2 years time limit for any kind of a proceeding under the Customs Act. This has also now been set in motion. So beyond 2 years, it can only be extended by another 1 year with the approval of the Commissioner. Customs Tariff Act is now being harmonized to international standards in HSN 2022, which is the 7th edition of the HSN. Next slide, please. So this is what I had on the indirect taxes front. Other proposals would not be very significant, and now I would like to hand it over to Himanshu to take you through the policy changes and implications. Over to you, sir.
Thank you, Sandeep. I would also, I learned a lesson today that Venkat, being a national tax head, and Sunil and Sandeep, all you being tax guys, I learned a lesson that one should never speak after the tax guys because the audience is already stressed. So I'm not sure how much interest I can evoke as far as the recent policy changes, but definitely I would definitely like to add is that this is probably not the first time wherein we are presenting our budget in terms of a negative growth. This has happened 4 times earlier, and in this backdrop and a pandemic which is a centurial impact. The 6 pillars of the focus area which the government has announced, the health and well-being, physical and financial capital, inclusive development, human capital, investment in R&D, and governance. So I would say that this I would try to kind of give a little comfort to the audience, but I would suggest that the audience should relax because there are certain positive aspects of the budget as well. So first, health being first. So this has been the tone in the budget itself, is that the government has really substantially increased the outlay in the healthcare sector. The healthcare sector in India is primarily consisting of primary, secondary, and tertiary healthcare, and which is provided by both government and personal healthcare providers. So the emerging trend for last 20 years, as we all know, is that more and more healthcare is being imparted in the private and personal healthcare sector. So the new can you make the next slide, please? Yeah, go ahead, please. Next one. Yeah. So the new scheme that PM Atmanirbhar Swasthya Bharat Yojana, which has been given in the budget, really talks about 5 major elements of healthcare. And I would say that one must give a fair credit to the finance minister and this government, as that they have tried to, it just doesn't really appear to be a mere announcement. If you really read not just this budget, but also various reforms that have been introduced over the last year in 2020 while we were all locked down, and also in the few previous year, if you go back to the first budget of the finance minister, this being third, you would see that this has been the focus area in terms of providing accessibility, public participation in the healthcare program, health promotion, as well as appropriate technology, which is being the flavor of this budget, also pushing on the technology and intersectoral cooperation. So if you really see that the healthcare is not just a standalone activity, but it touches upon various other segments, how these healthcare facilities will be conceptualized, implemented, and delivered. So definitely the COVID vaccination program and other vaccination program which are now announced are definitely going to give a massive boost to the healthcare segment, and all the service provider as well as companies in the healthcare would definitely be positively impacted by this resurgence of demand, or I should say not just pharma and healthcare, but also logistics. So this is one of the major factor and one of the key announcement of this budget. Next being the national infrastructure pipeline, wherein as of today 7,600 projects have been listed. This is nothing but primarily the investment grid which is announced by the government. It's an initiative starting from 2019 until 2025, wherein the government has on a best effort basis listed out or acting as an aggregator for various opportunities in infrastructure area. So the domestic company as well as the foreign companies can participate in these projects, and definitely this would be give a big platform for future growth. So what we are right now doing is creating seeding an ecosystem of opportunities in infrastructure, which are definitely going to give massive relief and growth to the country in near decades. So the NIP is not just about the greenfield; it also includes brownfield projects, and also it gives you an option to participate in these projects, not just for executing them, but companies which find these projects valuable or useful for them, they can help the government conceptualize and create the right framework of execution. Next is the DFI, which again is a big boost to the infrastructure, wherein the government is keen to ensure that they would fund these projects through debt mechanism, and this DFI will serve as a singular source of bridging the gap between funding and the implementation. The asset monetization program, I would not go into detail considering paucity of time, but then if one goes through the details of this program, the various projects in railways, national highways, and other course sector are definitely going to bring a lot of money to the government, which will fund these initiatives. So we might enter a positive circle of opportunities and funding and monetization. And the capital budgeting or focus on investing in capital expenditure is definitely going to drive the demand further. The more the government spends in this in view of this pandemic, and considering that we need to revitalize the demand in the economy, this would definitely have a very positive bearing on the entire economy. Next, please. So the power sector reforms have already been in motion. I would say that DISCOM portability would definitely give a lot of efficiencies to the sector, not just for DISCOM, but also it's a good news for manufacturers, which will support the creation of ecosystem in distribution companies. For our urban infrastructure, the key announcement of Jal Jeevan Mission, which is again a very long-awaited demand to provide clean water, would definitely create more opportunities in this segment, as well as the public sector service through private, public and participation mode. In what I read as per the statistics is that nearly by next 4 years, 10% of the total transportation by bus, the demand would be driven by India. And right now, as we have FAME 1 and FAME 2 scheme already in operation, which has forecasted nearly 7,000 buses in the electric buses should be immediately provided. The concept of 20,000 buses would definitely going to address the issue for a long term. Ease of mobility might help creation of smart cities, which has been a signature project of the government. 100 smart cities were projected in the year 14-15, which definitely ease of mobility between these cities and interconnectivity through metro rail as well as regional transportation system would aid movement of talent, rather retaining of talent in tier 2 cities. And of course, for the automobile sector, the voluntary vehicle scrapping policy is a welcome change. In fact, this is a good way of defining things. While we do realize the hazards of pollution caused by vehicular emission, but then the clear guidelines would help not just the manufacturer but also the consumer. And I can clearly see that if we go through the fine print, we can see that the clear push of the government is through cleaner technologies. And as I just mentioned, in case of urban infrastructure, I would say that even the electric vehicle seems to be the future of automobile in India. Next slide, please. Yeah. So a good announcement for textile sector. Production link scheme has created a massive buzz, not just amongst the Indian manufacturer, but also foreign players who should now look at establishing their production bases in India. The announcement of 7 textile parks with world-class infrastructure, plug and play is the buzzword again in this field, not just for them, but for all industrial parks right now. This would create global competitiveness, and I'm sure, as I can see, recently many global apparel manufacturing companies have relocated their presence or bases in India. This would definitely give them one more reason to look India for a long-term investment. And of course, the agriculture and rural development, as we know, this issue is very, very important, and it's one of the current affairs in the country. The announcements of the finance minister would really go a long way to soothe the nerves of the farmers community, and the fund allocation to the agricultural sector would definitely boost demand. The Operation Green Scheme, which is trying to enhance coverage to 22 perishable crops, besides OTP, onion, tomato, and potato, would definitely address the key issue of wastage in the perishable crop segment. And then, of course, the Security Market Code and Investor Charter is a welcome move. I, as a professional, a chartered accountant, we all know that the inconsistency between various laws can cause so much of an interpretational issue and can cause litigation. So this is a welcome change, and I feel that if the government can really crack this one nicely, this would give more confidence to the investors in India, and of course we can see more positive rallies on this on the stock exchange. Thank you. Next, if there is any slide. I now conclude my presentation, and I hand it over back to Mr. Venkatraman.
Yeah, thank guys, Sandeep, Sunil, and Himanshu for excellent presentation on the subjects of your respective areas. Now I have questions which are poured in. There are quite a few. Kim, we have about 7 minutes.
Yes, we do.
Yeah. Okay. Great. Let me pick up few. Since you said you are lagging behind the tax, there are quite a few questions to you. And the one which attracted me also, want to know what the budget 2021 has in store for boosting sector growth. This is a question posed. Want to know what the budget 2021 has in store for boosting manufacturing sector growth. Himanshu?
Venkat, can you quickly repeat the question once more? I could not hear because of the...
Yeah, want to know what budget 2021 has in store for boosting manufacturing sector growth.
Okay, so I say that I've already said this, that this budget should not be read as standalone. It should be read in continuation with various announcements that have been done over past 12 months, and not just 12 months. If you really go back to the reforms which have been done in recent years, this budget is, merely, I would say, as of date position to see the government intention. So the recent announcement of performance-linked, production-linked incentive, as well as giving a boost of NIP, this in terms of infrastructure, facilitating foreign investment in India, not just in insurance, which has been announced this year, which we all know has been not just an announcement in thin air. It is a demand of certain large insurance company which want to enter in Indian market, and therefore they have presented this to a memorandum to increase their stake in the FDI. So I would say that the manufacturing sector definitely is going to reap a lot of benefit out of these certain and clear guidelines, as Sandeep has also said, that this really defines the government intention very clearly. All these measures, be it healthcare, the announcement that if we see are going to give a lot of confidence to healthcare and pharma companies to augment their manufacturing capacities in India. If we really see textile, the 7 mega parks which have been announced will give a boost to textile sector. Similarly, automobile manufacturers, we know, they've been on expansion spree pre-COVID, can now really look at making their production plans for the very long term, which nearly covers 20 years. This scrapping policy is definitely going to give them some assurance as to there would not be any tweak in future. So all these, if you really see that these reforms have been very, very fundamental and structural, and I would say the major complaint of foreign investor or even any manufacturer in India is that there has been frequent tweaking of reforms. So if we really see that if these reforms are on the same trajectory as they have been for last 6 years, and this is the direction which is probably, I would say, the best for India, it remains, if this direction is continued, I would say that India could well be the one of the best alternative for companies to relocate their manufacturing to India.
Yeah, thanks. And that's rightly said, Himanshu. The outlay for manufacturing has tremendously been increased, and as you rightly said, the textile parks, the specialized textile parks, 7 numbers, which is a very, very welcome move. So, and also the scrapping policy in the automotive sector will also give a real boost to the automotive industry. So, as a whole, the key sector fully addressed, and the independent sectors or the ancillary sectors also will have its own consequential development. In our opinion, definitely it has given a huge boost through the second pillar, which has been announced as physical and financial capital and infrastructure. Yes. And one more question to you, to Himanshu. Comments on any concrete decisions, action, revival of hospitality industry in this budget?
Sorry, Venkat, one more time.
Yeah. Comments on any concrete decisions, action, revival of hospitality industry in this budget?
So I would say, Venkat, actually, hospitality sector, I would rather link it up with the real estate sector as well. Is that there have been a lot of revival of the government is trying to revive the demand in various sectors, and real estate, or which if we have good number of people trying to create asset creation or movement, as I noticed, the government is trying to also look into creating aesthetically beautiful railways for encouraging people to travel across the length and breadth of the country. I certainly see that this can boost the hospitality sector tremendously. Also, the hospitality sector is one of the sector which has been suffering massively during the COVID time. So recently, the government has come out with a framework on under the Insolvency and Bankruptcy Code, a framework of pre-pack insolvency scheme, which really allows these not just hospitality sector but also many other sectors to revitalize themselves by negotiating with the lenders and the creditors and trying to be solvent. So I definitely see that this budget is only augmenting the recent efforts by the government, and what we can also say that if there is an overall revival in the economy, it would definitely have a multiplier effect on various allied sectors. So one should really look at the holistic view of various impacts, and then we definitely can see that it's a win-win budget.
Yeah, actually, just to add, hospitality sector stems its or it derives its strength from all the attendant, all the manufacturing, all other economy as a whole. It depends. So when we are seeing a very clear path in terms of development in manufacturing and other services, or which is going to happen, I have a clear. I mean, the budget also, there is no need for a specific thing, but definitely there is going to be a revival, which is going to be it's a consequential, is our view. Sunil, I have a very interesting question, because you love this topic. Given the wider scope of equalization levy, how is the revenue expects to monitor transactions that are subjected to EQL?
Well, I think that I think the most interesting part is that I don't think that the revenue will be able to monitor it. You see, the way assessments are done today is that you focus primarily on the books of accounts, right? I would imagine that if the tax officer wants to now see whether any part of my transaction is done electronically or not, they will also have to understand my business model too. And that would require a lot of time and understanding, from any tax officer. So I would say the expectation is quite huge, but I don't know how far can it be met. Let's see.
Okay. And one more question on this equalization levy again, which is whether there are any rate changes or change in the regulation related to the EQL.
Sorry?
Whether there are any rate changes, the 2%, or change in the only.
No change at all. No change to the rate or the way they charge it. Anything that was introduced on April 1, 2020 remains the same.
Okay. I'll one question to Sandeep. Somebody wants to understand the changes made to the rebate process in GST.
See, no specific change has been made with respect to the rebate process under GST, so to speak of, other than the changes made with zero rated. You know what, you could probably link it up to where the exporters were using the mechanism of exporting under payment of tax in order to get certain kind of tax credits which were not permitted when you were exporting without payment of tax. I think that that shelter has now been taken away. But other than that, the rebate mechanism is largely unaffected.
Thank you, Sandeep. I think for want of time, we have many questions, but definitely we will consider it and send it across to everyone through the mails. But I can't resist this particular question. This could be a last one. Let me see who will take it, or otherwise I can take this also. Please also advise on the depreciation on goodwill to be continued. Please also advise the depreciation on goodwill to be continued under Companies Act or not. This is
my view is I do
because of the removal of goodwill depreciation under the Income Tax Act. This question is asked. Anybody is one of our colleagues can pitch in and do that. Otherwise, I can do that.
No, I don't think
Venkat, I can quick one here, but I think you can do much better than me. So go ahead and please enlighten us.
Okay. No. Basically, I think probably I'll be overstepping in or transgressing into the area of my assurance colleagues if I do that. But I think we don't have to give any we don't have to do any changes in respect of charging depreciation with respect to the Companies Act for the purpose of preparation of accounts. And this is only with reference to the income tax is my considered opinion, because the valuation of goodwill and the to what extent it has come down and to what extent it has to take the P&L hit, all these things have to be definitely be considered. Leave alone the tax benefit which you are going to get or not, because tax is a totally different one, and you cannot change the true and fair view will be known on the basis of books of account, and for that the goodwill impairment testing is absolutely necessary, and it has to go through the P&L account is my considered views. Kim, I think we can take all the other questions separately and send to everyone for the benefit of having attended, and so that everyone will be benefited and we too get benefited. And
Yes, of course.
So with this, I thought we'll end the question and answer session.
Thank you so much. And thank you, Venkat, for that. Thank you, my speakers, Sunil, Sandeep, and Himanshu. And to everyone who logged in, we will be sharing a recording of this session by tomorrow afternoon. Link to the recording will be sent to all of you. If you have any further questions, please send it in. We were not able to cover all of the questions in the Q&A session, and our apologies for that, but we will get back to each of you individually. Thank you so much. This is the end of today's webinar.
Thank you.
Thank you. Bye-bye.
Bye.